Welcome to The Lumber Word, where industry veterans Matt Beamer, Greg Riley, and Ashley Buckholt dissect the world of commodity lumber each week. We bring you up-to-date insights on supply, demand, and market trends, sharing our trading expertise to benefit everyone in the supply chain. Join us for informative and entertaining discussions that guarantee to make you wiser about all things lumber.
Everybody, welcome to this week's episode of The Lumber Word. It's going to be number 103. It's December 18th, 2024, and we have a reoccurring guest, Brian Wesbury from First Trust. Greg and Brian have been good friends for a long time, so Greg, I'll let you reintroduce Brian again.
Brian doesn't need any introduction at this stage of the game. I mean, he's kind of a household name, whether you've seen him on Fox Business, in print, or, at some fancy gala. He's a household name, legitimately. Former chief economist of the Joint Committee of Congress. And, I mean, he's the ultimate road warrior. Brian puts more time out on the road than anybody. He's like, if anybody ever sees that First Trust is in town, you want to call your broker and you want to get in there for that meeting. That's for sure. Brian, great to have you on.
Great to be on, Greg.
Today we had some data out first, very timely. First thing this morning, we had housing starts for November. Maybe you can give us your read on it. That'd be great.
Yeah, it was weak. It's kind of interesting that we have two things that are positive in housing. Number one, permits are up. I guess multifamily was the real weak part. Single family homes went up, but permits were up. And the other thing is that we are completing homes at a record pace. And the number of homes that are under construction right now just keeps plummeting. I still can't figure out what's going on with the housing market. I get it that we have high rates, higher rates, but housing has not, after COVID, even if you average all the numbers out, the big spike after COVID or during COVID, even if you average them right now, housing, the number of houses being started, the number of houses being sold, the number of houses, anywhere you look in the housing market, it's weaker than it was in 2019, which means we have not grown in housing for 5 years. And I get it. There's a lot of activity, homes being built. But if you look at total numbers, we're below 2019. By the way, it's also true that we're on car sales below where we were in 2019. So it's a really fascinating world out there. I think part of it is, and this is going to take us away from housing, but the printing all that money, spending all that money. If you had assets, if you owned a home or owned real estate or you owned equities, you won huge. But the inflation that it caused means that if you didn't own assets, you got crushed. And I kind of look at the world in it's bifurcated. One side is doing fantastic, the other side isn't. When you put it all together, the housing hasn't gone anywhere in 5 years. And by the way, neither have autos. It's a strange world to me.
Well, the only thing that's not weak in housing is the price of housing, right?
Yeah, exactly. And that has a lot to do with it. But that's my point about if you're a financial advisor, if you're building homes, if you own a home, if you won with all this inflation. But if you don't have assets, you got crushed. And
yeah, I miss COVID. I really wish, COVID was really a great time to be in the business.
Yeah.
I miss it. It was easy to get on. It was easy to get on a plane. Traffic was great. I miss it. I miss it.
Yeah. Yes, exactly. Every plane I'm on these days is packed full. It's not going on in housing right now.
Go ahead, Ash. You want to transition a little bit there and talk about tariffs and new administration? You want to tee that up?
Can we talk about the shock of actually not growing in single family homes in 5 years though? Like when you put all of the construed data together and you consolidate it, Brian, that's it's kind of a little bit of heartburn for our industry if you look at it from a broad stroke perspective for multiple reasons.
Yeah, it is. I mean, and my problem is, or I guess I shouldn't call it a problem, but is why. We all know interest rates went up, but even if you go back to when we had much lower rates, housing was better than it has been, but it still wasn't a big growth above 2019. So pre-COVID seems to be kind of the high water mark. I get it. Everybody bought second homes in Hilton Head and Florida and everything during COVID, but that was just a little spike. But if you look at it, housing's just been trending lower, and housing is less of, that was a big part of the presidential campaign. Housing isn't affordable. And if you want to know my thought about why it isn't, if we take federal government spending, it's 24% of GDP. State and local government spending is 20% of GDP. And then the cost of complying with regulation, which means, all of us have to do our taxes. You got building codes, all these things in every business. That's 7% of GDP. Add it all up, and the government takes over 50%, 51% of everything we produce and pushes it in a direction that it wants, like solar panels and windmills and things like that. And if the government's taking half of all production, that means they're taking half of all incomes. No wonder people can't afford a house.
So I guess that kind of leads me into, so maybe, if we go back and we say that 2019, we look at the administration that's been in place that has been displaced because of their policies that basically hurt people of lower and medium income because of their policies, and misdirect investment or dollars to things that not necessarily productive. What's your outlook for the new administration coming in? Are we, the stock market would indicate that it's going to be like, party like it's 2029.
Yeah.
What's your outlook?
Yeah, I'm looking at the market. I'd love to get into some of this conversation because
we're in it right now. We're in it.
Yeah, the time I compare it to right now, so we kicked out Jimmy Carter, we put in Ronald Reagan. I would have always said Carter was the worst president of my lifetime. Now it's Joe Biden is the worst president.
Hands down.
Way worse than Carter. And so that would be the comparison that I use. We're putting in a tax cutter, a deregulator, and hopefully a spending cutter. And that's what Reagan was. And that caused a boom in the economy. Here's the interesting thing. The S&P 500 in 1980 had a 8.5 PE. All right. So Reagan had a ton of upside in the stock market. Today, the PE ratio is 67.5. And so I would argue Reagan had a way better runway with the market, the stock market, than Trump does. He can do all these great things, but are we going to go to 35 PE, 40 PE, 50 PE? Either earnings have to. In the last 2 years, the S&P 500 is up 62%. Earnings are up 5%. And so something has to give. Like Trump's policies are good, but are they going to increase earnings by 57%? I don't think so.
I got a question for you, Brian, because I actually kind of dive into this point a little bit with some financially astute people that I talk to. So interestingly enough, the S&P has grown as much as it has for a very specific reason. There hasn't been another investment vehicle over the past 5.5 years that have made it attractive enough for them to deploy capital elsewhere, right? So, with some of these policies changing and interest rate cuts and real estate investment and development being a little bit more cash flow friendly, for lack of a better way to describe it, is that going to release some of that powder keg that is in the overall stock market or securities market and reinstitute it back into other alternative, I'll use air quotes, investments?
Yeah, Charles, that's a great point. And so when I kind of look at Trump's policies, and remember, the word populist always scares me, like because populist means I'm going to make people happy, right? Like I that's what it means in my heart, but I maybe means something different to Trump. But what I think will happen is that that Main Street will be the real winner of a Trump administration. And so I guess you could call that populism. In other words, Wall Street already won. And it's really hard for me to imagine that the stock market does another 25% year. I mean, it could. We did it back in 97, 98, 99. But what I think will happen is the benefits of Trump's policy will affect Main Street more than Wall Street, which is exactly what you're saying. It'll go into other areas of the economy.
I just was going to say he's already served as president once, and that's who benefited the most from his previous administration was the lower income people and the middle class people. Actually, on a percentage basis, grew their salaries and their incomes and their wealth more than any other group. A lot of people don't understand that about Trump. They call him a populist or a businessman or whatever, but his actual policies of governing helped the lower and middle classes the most, not the rich. So, who's gotten wealthy in the last 4 years, Brian, to your point, is the people that have assets, that have money, and now Wall Street. Hey, I'm not complaining. My 401k looks better than it did before, and I have assets, right? So it's good for me. But at the same time, I was talking to a buddy of mine who's he's a very smart man, self-made millionaire, and he trades a lot of lumber futures, and he's in the lumber business, but he also is kind of one of these Chicago money guys, knows where all the bodies are buried. And he said today that our affordability index is as bad as it's been since 1987 for homes. I mean, that's 37 years ago. And back then a house cost $80,000. Now they cost $400,000 for a starter home. I'm reading this from our buddy Lance Lambert, Ashley, on Twitter from about a month and a half, 2 months ago. He said, in order for pre-pandemic housing affordability levels to get back to 2019 levels, we'd have to have home prices fall 38%, mortgage rates go down to 2.23%, or incomes rise by more than 60% to create the affordability that we had just
I'll take door number 3.
Door number
three. We have door number
we're not going to get that. We would love to get a combined single household income of $134,000, but it's probably not in the cards in the immediate future. And if we did that, we'd have massive inflation, right? We'd have people out there. The car problem and the house problem would sort itself out, but those prices would go up because there'd be a lot of money floating around the system. So how do you
combination of all three of those maybe?
Yeah. So the big picture 5 years from now is how do we return to normal without bankrupting large segments of American society?
Yeah, and I think Trump's if you keep the tax cuts in place, I think that's absolutely essential. If he cuts taxes on tips and overtime, that's huge. I mean, it gets us partway to the 60%, right? I'm not a lot of it, but we move toward it. And then if you deregulate, we can make this economy so much more efficient than it is today. And then I don't hear a lot about this coming out of Doge, Elon and Vivek, but we have got to stop. We pushed $400 or $500 billion into clean energy, solar and wind, not nuclear, which, by the way, when Google spends its own money, that's what it wants. It doesn't want solar and wind. And so we need that's where we need to go. We could do things that are so much more efficient. And unfortunately, it just takes some time. Reagan, the market went up into the election because it expected him to win. It went up right after the election, but then 1981 was ugly. And I get worried about that right now because the only reason I think we haven't had a recession this past year is because we ran a $2 trillion budget deficit. That's why we
No,
even though the
Brian,
no,
money.
Brian, we actually had a recession, just nobody wanted to call it that. We've actually been in a recession here for 2 years, and nobody wanted to acknowledge it politically. It was too
some
much.
people. Yeah, at least for some people, that's for darn sure.
That would explain why we have 9 months worth of houses available that haven't sold, right?
So when I look at my investments, I've got some that make sense to me and some that are working well, and I have no idea why they are. So I put some stuff into. So Wall Street's made it real easy to invest in crypto now. They've packaged it real nice, and you can put it into ETFs and all this. And makes no sense.
Don't tell me you bought Fartcoin.
And it keeps making money. And I bought a Bitcoin ETF, right? Just to jump into the flow, right? And
he bought shit.
Makes no sense.
He bought shit.
But
that's the wallet of all of them, isn't it?
I'm trying to jump on the.
I mean, you got to dump some money in that,
but
baby.
I'm trying to jump on the digital gold rush and the momentum of it, right? It doesn't make a lot of sense to me. We can come back to that. But some things that do make sense is like. And looking, there's been a handful of companies in the S&P that are driving a lot of it. So Tesla, great. I think I'm using it as an AI play, right? In a way, and other benefits of it. Yeah. So you're a big productivity person. Will productivity with AI and some other inventions help move us along through some of this?
Yeah, not unless we cut the size of government. I get accused of sounding like a broken record, but I swear every single one of our problems in this country, every one of them is the pure size and scope of the federal government. And it goes back to what I said. If you take 50% of everybody's income, no wonder people can't afford houses. I look at this last 20 years in the United States. Think about the technologies we've had. We put the computer on the desktop. We had a cell phone, smartphone, the cloud, we Ozempic, it's all of it. It's like unbelievable technologies, right? Starlink, SpaceX, all these things. And we spent money like drunken sailors. The government budget in the last 20 years has gone from 3 trillion to almost 7 trillion. And the Federal Reserve held interest rates at 0 for 9 years out of the last 15. And even with all of that, we only grew 2% a year. All right. That was it. 2% real growth. By the way, our grandparents after World War II, that was 4.5% per year. So, but my belief is that's what the bigger the government gets, it's a ball and chain on the economy. It's a wet blanket on entrepreneurship. So even though we have AI and we have all these things, we still can't get growth up. Profits are up, but growth isn't up. And I think in order to get that Main Street kind of rally that we were talking about and a broadening out of what wins other than just stocks, you have to get growth up. And the only way to do that is to shrink the size of government. I know I sound like an anarchist or something right now, but they need.
But you're a free market guy, right?
Yeah.
And when you start looking at regulation and all the things that are going on in taxation, right? The reason why we exist as a country is because our founding fathers thought taxation was theft, right? We threw away a whole shitload of teeth, right? By hand. Let's start there, right? Yep. And the fact that we've seen so many communist institutions, right, not work. Right. And at the end of the day, you have a government entity, right, that is so massive that the inefficiencies that exist in it are mind blowing, and the amount of money that is absolutely wasted, is you can't account for it.
Yep.
So I agree with you, Brian. That's definitely where it starts.
So we're all cheering for Doge to, do things that are really, really like special. And obviously one of the challenges there is that discretionary part of the government is such a small relative part. But I think Brian, you and I talked, is like if they could find a way to save $200 or $300 billion a year. Yeah, you would just tip the scale, and over the next 10 years, that's $2 or $3 trillion.
Right. And if we got more efficient and got more growth, we'd get more tax revenue. So every little increment helps. It's just, we all know the formula. they think they know the formula. The John Maynard Keynes, we're just going to hold rates at zero and print a lot of money and spend a lot of money, and that'll make the economy go. And it doesn't work. I mean, if that's not what we learned from this last 20 years, I don't know what you can learn.
Brian, how do we get, we're all talking about federal top-down viewpoints here. How do we get the states and the cities and the counties out of the 20 to 25% cost of construction and interference with building permits and coming up with new rules at the last second after developers already started breaking ground on things? I mean, this stuff happens all the time in places like Portland, Chicago, New York, Denver. And nobody wants to talk about those hidden costs, which are sizable. I mean, they could be a quarter of the budget of a development. So, not to mention just the time delays that come along with it. And all developers hate time. Like they want to get stuff done as fast as possible. And that way they can start generating revenue and pay back their loans. What are your thoughts about how do we get the local and city and county governments out of this using the building industry as a piggy bank type thing?
Yeah. You know how they say everything starts in California? Well, it's like whatever it is, like whatever new thing it is. Well, I think our world right now, we're going to start seeing everything starts in Florida. Florida is becoming more powerful by the day, economically, number of Congress people that they have, the power of that. And I think once one state becomes more competitive, then you can't, no one can compete with Florida right now, that you have to go down that road if you want to stay competitive. So you just put the pressure on. I just, today, all over the news is Brazil is collapsing. And I think part of the reason it's collapsing is because Milei in Argentina is winning, right? So one team starts to win and they're using a wishbone in the backfield. I know I'm dating myself. Then everybody uses the wishbone. And so, so that's or the West Coast offense or whatever it is. And I think the same thing happens.
Whatever we're not using in Chicago with the Bears.
Yeah, exactly.
Whatever it is, we're not doing that.
Yes, exactly. But I think that's how it starts, that you have to have some winners that show the way, and then that forces other people to follow behind. Now, Chicago might be a lost cause. Like
look at Germany
in the city, but
right. Look at Germany. But they just had a no confidence vote, and it's driven heavily by their move to green energy and what that's meant for cost and availability. And so you're going to see a big shift there. We hear a lot of things about what's happening north of our border here, and the guy that's next in line, if the governor steps aside, is much more of a free market, right center guy.
Did you just do that, Greg? Did you just go pull the governor card out? Did you?
I did. It just seems like it's such a thing to do these days. Hey, listen, the guy has a 22% approval rating in Canada, so no one up there is going to be upset about that.
So speaking of,
you know where he is today? He's on a jet in Hawaii right now. He's taking a vacation. Times are tough for him.
Yeah.
So
exactly.
speaking of Canadian, so I cut out for a bit a while ago. Tariffs.
Yep.
So that's the big buzz in our industry now, Brian. As a matter of fact, this morning the price of lumber went up on the futures. People were calling around. Big mill in Canada said as of January 20th, they're going to put a 25% adder on the price of their lumber because they're afraid there's going to be a tariff. Greg real well. Greg's like, we don't believe that ever is possible to add that
0% chance.
Yeah, is there a 0% chance, or are we off on that?
I wouldn't go as far as Greg with 0, but I think it is low.
Okay.
Trump I just saw he did a press conference. The guy is unbelievable, by the way. He stood there and took questions of from every different direction about every different topic.
He answered more questions then than Biden has answered in the last 4 years.
Yeah, it was unbelievable. It was a tour de force. It was unbelievable. But he had Howard Lutnick there, the Commerce Secretary. He's nominated for Commerce Secretary. And when they asked him about tariffs, he used the word reciprocity. If you tariff us, we're going to tariff you. And I think Trump followed up by saying that's exactly right. And so that fear that he was just going to tariff everybody, like the everything, tariff everybody and everything, like 20%. I heard him say that. He says things like tariffs are the best word in the English language. But what I think he's using it as a negotiating tool. And I do believe he's going to go after China with tariffs for sure. And then any country that tariffs us is going to get a tariff back. And I think in the end, what that's going to do is drive tariffs down, not up. So I know all these people, everybody's worried about it. Farmers are really worried about it. You guys in the lumber business are really worried about it. Steel is worried about it. People that use steel, that is. And I think he's been talked out of this just overarching tariff on everything and everybody.
Hey, it's Ashley from the Lumber Word. For over 30 years, Random Lengths by Fast Markets has been my go-to source for unbiased and reliable lumber market updates. Every week I look forward to digging into their insights on pricing, trends, and market activity. Now they've taken it up a notch with the Fast Markets Lumber Dashboard. It gives you a clear, easy-to-use view of price data, trends, and news all in one place. You can customize it to show exactly what matters to you with widgets, which I call tools, and charts that make the data come to life. Whether you're on your desktop or in your browser, it's simple to use and incredibly powerful. After the Random Lengths team walked me through it, I can tell you it's a game changer. If you're in the lumber supply chain, this could give you a real edge. Check it out at fastmarkets.com and see it for yourself.
Do you think some of those, as you describe, reciprocity? I think that's how you say it. Reciprocal tariffs.
Big word, Charles.
It's too many syllables for my English language. The reciprocal tariffs. Do you think that's going to create a situation to where there's more of a reshoring on, the stuff we don't think about that's manufactured overseas is going to come back due to that, which could in turn increase household incomes and all the things that we kind of talked about?
Yeah, I think it will. This is all part of that populist movement, and I think it will end up making our products more competitive because we're saying, hey, you can't just tariff us without getting tariffed back. And I think people will lower tariffs. We're the most productive country in the world. And then the second thing is, I do also believe that they will use tariffs strategically because there are some military goods that we have a hard time producing without imports, and also drugs. I mean, my understanding is that Tylenol, Advil, like aspirin, if we don't have China, we can only make about half of what we make. And so to me, that's dangerous. Like if we need to be able to produce our own military goods and our own drugs in order to stay safe in the future world.
Like you saw, the perfect example is, there's this move to go to what is, the best energy alternative that's clean, which is nuclear. Yep. And then all of a sudden, we come to find out that, we get 40% of our uranium from Russia.
Yeah.
Like, makes zero sense, right?
Yeah.
I mean,
yeah, we'll be looking. I think that's the way they're going to use these tariffs strategically. And and Canada and Mexico are number one and number two trading partners. I think Trump does want to have a much smaller deficit, but the way I think you do that is you make other countries import more from us by getting rid of the tariffs they have on us. And the only way
it's $100 billion deficit with China. I mean, with Canada, And, to your point, it's, hey, like import the stuff from us instead of other places that you're getting it from.
Right. Exactly.
Yep.
Some of it's currency related, though, right? I mean,
Yes.
We talked about equities, but if we just talk about commodities, what do you think? What's your outlook for commodities going forward?
I like real assets. I love real assets, baby.
Buy wood, baby. Buy wood.
So and this is going to go back a ways, I'm sorry, but I'll get there pretty quick. The Federal Reserve printed 40% more money, 42% more money during COVID. That's where inflation came from. And then in late 22 and 23, they actually contracted the money supply. It fell, and that would normally cause a recession. And so the question is, why didn't it? And I believe part of the reason is the last 2 years, we've been running $2 trillion budget deficits, or real close to it, in spite of having unemployment under 4%. So in other words, Keynesianism works in the real short term. All right. But I already explained what I think about the long term. The bigger government is, the slower we grow. But in the short term, it actually works. And I think half of all jobs in the past year were created in government and in healthcare. Half of all the job growth. And that shows you that this economy, like Matt, you said, we've been in recession for a long time, but government spending has hidden it. So, and now make my next step. If we take away that deficit, if DOGE is successful, if we can get it from 2 trillion to 1.2 or 2 trillion to 1, that all of a sudden the economy loses the boost from that big deficit spending. And then the question is, what's the Fed do? And especially when you lose half your job growth, when you start seeing economic data get bad. And I'm convinced the Fed's going to cut rates and start printing money again. And inflation is not gone. The embers of inflation are there. And all we need is a few little sticks and a few pieces of wood on the embers in the morning, like we're camping, and boom, we got a fire. And that's the thing. I think inflation is still there. So I like real assets. I love them.
Buy lumber.
Buy lumber.
Buy lumber.
Hey, Ash, you want to do a quick review of the lumber markets?
Yeah. So basically, the lumber market on everything, we'll carve out Southern Yellow Pine separately, Charles, but everything outside of the Southern Yellow Pine market has been pretty much selling off for 3 weeks. Greg, does that make sense? 3 weeks. As a matter of fact, we went into a pretty much a big sell-off on lumber futures, went a big discount. We had a big rally today. Yeah, sorry, the connection was going in and out. So, Charles, why don't you go into the Southern Pine market? Greg and Matt, you do your markets.
Well, I mean, overall, it's seasonal, right? I think we can all agree it's seasonal. I think, some of the things that have happened and transpired in alternate markets, such as spruce and Doug fir, have been affected by what's been going on for the last, 3, 4, 5 weeks in pine, 6 weeks now. But the one thing I will say is that I think we're finding bottoms in a majority of the items that we produce, which is good. The strongest thing that I've seen is probably 6-inch. It didn't get back near what everything else did. And I think a lot of that has to do with the same thing that we talked about last time I was on here. 2x6 16 spruce, Central Florida, $795. Southern Yellow Pine, $395. I mean, I think that's the biggest reason why 6-inch never gave back as much. But we're experiencing all the things that we've already discussed to a certain extent. You got higher lows and higher highs. And that puts everybody in a real interesting position, because even though you get a pullback, everybody wants 30 under that because they've seen it in the past 90 days, 120 days, and they expect it to happen again. Well, I mean, history doesn't always dictate your future. So you can put yourself in a pickle if you set yourself up that way, price-wise on the sell side. So it's kind of a unique little bit of a, Western standoff to a certain extent. There are certain items that are extremely liquid and certain items that are just floating along and you can get orders and move on, and some you can't. Panels are the same way. We're kind of at a sticking point at these levels, but it doesn't seem like there's a lot of weakness because you got some stuff going on the supply side, especially out west. It's going to pull a lot of Eastern board that direction, and the fact that some of this imported stuff, the volumes aren't going to be there. So I think Q1, as we've suspected, is going to be interesting, but I think it's going to be interesting for different reasons than we originally thought. My 2 cents. Don't know if it's worked that, but here we are.
Matt, how about the Pacific Northwest market and Western spruce?
Well, we're susceptible to the sell-off just like anyone else, right? We've had to go out and find the market on things that we want to sell. Mainly what we want to sell has been two before. That seems to be the weak link of the industry here for the whole year, really, just two before anything. And so we did find numbers this week and last that worked. We've been actually having a better week than I expected this week. I think part of it is the prices have come down 50 to 75 bucks, I mean, well, hey, lower prices should attract some attention. But also the scuttlebutt out of Canada with Fraser coming out with this 25% price adjustment FOB mill as of January 20th. That wasn't the first time I had heard that, by the way. I've had several Eastern Canadian mills reach out to me, send me emails with articles that have been published up in Canada about how they're really concerned about the Trump tariffs, blah, 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 blah. Meanwhile, I'm in Greg's camp. I think the odds of that are hovering around zero. And so I don't really care about, Trump's tactics. Trump has a way of playing poker. That's the game. He plays that game very well. Doesn't mean it's going to turn into actual policy on January 21st. So I don't care about that stuff, but it is getting the money moving around in Chicago here the last couple of days. We've gained $30 of equity just on emotion. And so it's cool to see some bottom pickers coming back into the market. And there's some smart people buying lumber here the last 72 hours. So I pay attention to that more than I do the price of things. I think that this is the time of year where it's really hard to make any big judgments about where lumber's going or what's going to happen in the next 2 or 3 weeks, other than Christmas, and New Year's. And a lot of people are distracted. So like I always go back to what I said last week, which is if you're a young guy or if you're looking to pad your year-end stats, stay in your seat for the next 2 weeks and don't take time off from work, because there's going to be some mills that are going to make some phone calls on December 27th looking for some orders that you might be the only guy in the industry that answers the phone, and you can negotiate some deals and make some quick money. That's a tip from an old guy that used to do that when he was younger before I had 4 kids. So anyhow, there's my thoughts. I think bottom line is we've had to give back, 10% on the price of lumber here, but we're now attracting a fair bit of orders as of midweek here in December.
Greg, what's your thought going into the end of the year and the beginning of the first quarter? How to play it?
I think to a certain extent, the sell-off went farther and deeper than
Boston.
People anticipated. That kind of froze some folks. And it was it was a surprise. Futures did go to a discount, and that was really uncharacteristic for this time of year going into. I mean, we all have to acknowledge that lumber makes a seasonal high in the first quarter. When I look at the Eastern spruce market coming back on January 6th, difference between this year and last year. Last year, we have, weather was absolutely fantastic. We don't know what weather's going to be just yet, but these mills were cutting cheap timber from the burn timber from the summer. And so they were all running full bore. Right now, these mills are running the one shift just to keep things going. And at the current prices, there's no incentive to increase that. So, I'd have to think that, we should see some further strength in the first quarter. I mean, the only kind of governor on that is we're going to see increased Euro shipments in the first quarter. They're already on the water or getting on the water, so that'll dampen that somewhat. The real wild card is demand. I mean, we're limping along at numbers, at 1.3 million housing starts, and in a country that needs to be building 1.5 to 1.6 million housing starts. And when is that going to rectify itself? The challenge there is we saw during COVID is when you try and go above 1.5, 1.6, there's a shortage of lumber. So, I don't know what that catalyst is going to be, but that's kind of the thing to look on the horizon.
Well, here's a question I got for you, Greg. So on that specific topic, a lot of these home builders are holding anywhere from 9 to 11 months of inventory from everything that I read.
Yeah.
They got to get rid of that buildup before anything major happens in single family. But the one thing that I do acknowledge is that this time is a lot different than any other time that they've had extended inventory because of the amount of, profit that they have per unit, right? So it's a lot easier for them to cash flow and carry that stuff than it has been historically. But at what point do some of these home builders that everybody sees their, quarterly releases say, you know what, I'm willing to take a lower percentage to move the volume to get us back to a healthy, more balanced environment? Does that happen in Q1, or does that happen in June when they still have 10 to 11 months and they've just continued to build?
You see what's happened is that it's apples and oranges. It's not apples and apples, but the average price of a new home in the country is the same price as an existing home. Historically they carried a significant premium, and that probably masks the buying down of the mortgage rate, because the big national builders are all offering 4.25%, 4.5% mortgages that, smaller and medium-sized businesses, the builders can't offer. Charles, your point is, I think they're going to keep the product moving. They're probably willing to carry a bigger inventory of those homes with the thought process be they have quick move-in stuff, particularly people go as we move into next year, and that continues to be the only option, then that's what's going to drive their sales.
Charles, if we get a bump in consumer optimism, there has been a sense of optimism here since the election. It's palpable. And Brian, your buddy Charles Payne, who I'm a big fan of, always talks about animal spirits, right? And I think that's something I've felt in daily life. If that leads into higher incomes for the average family going into 25 and 26, and we can get a stabilization of mortgage rates or even a softening slightly, then you could see a lot of that inventory get swallowed up, right? And it wouldn't, I don't know if Brian, you might know about this, maybe Greg does, but are the institutional investors in housing taking a break, or are they still buying like entire neighborhoods and renting them out?
Yeah, I think they've taken a break, but I'm not an expert in that market. They've gotten beaten up pretty good. BlackRock, everybody. Even VP Harris blamed BlackRock for high house prices. So I think they backed off.
It certainly appears that they have.
Because that's how Trump talks. Trump talks about growing the economy and creating more opportunities that way, rather than doing it the way the current group has been doing it, which is massive government spending and government hiring practices.
Yeah, exactly.
What do you think the lag is? You look at a lot of things, shrinking the size of government, like you said, in the short term, that's got to be a negative. In the long term, it's a positive.
Right.
Tariffs may, or maybe the flip side is, the run up into potential tariffs are positive because people do some insurance buying and hoarding. But then once the tariffs come in, then it's a negative. Then
Right.
It ends up being a positive once you reshore that production. There's all those long and variable. The one thing we haven't talked about yet is interest rates, and I hear that in the next hour or so we're going to hear about that. What's your outlook for today and down the road here?
Yeah, they're gonna cut a quarter, and they're gonna mention pausing, like no doubt about it, because inflation right now, there's 35 measures of inflation, and most people know about 4 of them. But if you average them all out, it's about 3%, and 3% plus 1.5, you're at 4.5. We're kind of about at right interest rates. They're not massively high. They're certainly not too low. So, I think they're going to keep the door open, but they're going to signal that they're willing to pause. And I think one of the reasons is the last CPI number, last PPI number, were both hot. You have PPI running at 4/10, CPI at 3/10. Inflation is not dead. There's still embers in the fire pit, and they know this. And then I think also they did a 0.5 point cut, that first cut. They did not need to do that. I think it was completely political. I don't think Powell likes Trump, and I think he's willing to pause right there and make it tougher on him. I think he is. And so a quarter today, and then the big, I guess, question from my point of view is what happens with the money supply. And so one thing Congress did is they suspended the debt ceiling up, and it kicks in again on January 1st of next year. And so now all of a sudden we have this debt ceiling. Well, one of the things the Fed's done with monetary policy is they've created this what's called a Treasury General Account. And the Treasury right now has $700 billion in that account. And what's that? Yes. And once the debt ceiling kicks in, they're going to start spending that money, which means that comes back into the money supply. And so that's going to happen in the first quarter because we're going to hit this debt ceiling, or it's going to come back, and the Treasury is going to have to use this cash that they built up in their slush fund. I still don't understand why they have all this money in an account at the Fed, but they do, and they're going to spend it. And that means the money supply is going to increase when that happens.
But why don't they use that to cover some of that deficit?
Yeah, that's what I wish they would just cancel it.
Just wash it.
Just give it back. Yeah.
Wash it out.
It's their money anyways.
Yeah, it's unbelievable. We are all paying interest on $700 billion worth of bonds so that they can have $700 billion in cash sitting at the Fed. To me, it's like insane. But nobody ever asks about it. Nobody talks about it.
We got to get Ron Paul on here, Ashley. We got to get Ron Paul.
Yeah, he does. Yeah.
I mean, what? So we can ask him about Fauci?
Yeah, exactly.
No, that's Rand Paul. I'm talking about his dad, Ron Paul. He's a big enemy of the Fed, has been forever. Yeah.
And the Fed.
I have to cut it. But you guys keep on going. But I gotta go.
Hey, Matt, Merry Christmas. Enjoy the family, brother.
Matt, Merry Christmas.
Thanks, you guys. Thanks, you too,
Adios,
Brian. Take care.
Yeah.
We got to wrap, don't we, Ash?
Yeah, I think that's we're at almost 50 minutes. So Brian, I appreciate you coming on.
Absolutely.
Charles, Greg, we'll do this again, and glad you're back from traveling all weekend long, or all last few weeks.
Hey, Brian. Yeah, thanks so much for being on. We love having you, man. It's awesome. It's awesome.
Absolutely.
Good to chat with you, Brian. Y'all be good.
Good to see you,
Thanks,
Charles.
Brian.
Good to meet you. All
Hey,
right.
Merry Christmas there, Charles.
Yeah, Merry Christmas.
Hey, thanks, fellas. Y'all too.
Take
We
care.
can say
Take care,
that now.
everybody.
I will do my best.
All right.
See you guys.
Yeah.
Thanks for listening to this week's episode of The Lumber Word. The Lumber Word podcast is dedicated to engaging conversations about the lumber industry, including trading ideas, market trends, and evaluations of overvalued and undervalued assets. We wish to emphasize that the discussions and opinions expressed in this podcast are purely for informational and entertainment purposes. They should not be considered as financial or investment advice. We encourage our listeners to make their own financial decisions, taking into account their unique circumstances and financial goals, and to seek professional financial advice if necessary.